Welcome to another episode of the Lazy Equity Podcast. We've got Geoff Lai here today from Strategic Brokers. Geoff, thanks very much for joining us today. You've come through with a lot of education and a lot of success over the last couple of years, winning the EP6 position last year, 2024, for being essentially in the top 100 of the best brokers in Australia. Why don't you tell us a little bit about that and who you are and just your journey to get where you are today. So thanks very much, mate.
Thanks for having me. A bit about my journey. I'm quite a new broker. This is my fourth year. So when I got that award, that was my third year in broking.
Wow. That's a very fast climb.
Yeah. I do have some good mentors. We do have some good systems in place, good understanding of, obviously how the investment journey works on the back end, being an investor myself. But in all honesty, that list is just a icing on the top, basically, just to say that, hey, what I have been doing for my clients literally sounds across because it's rated, 100%. It's verified.
And that's the difference with this award, is that it's not actually a sponsorship award. It is actually rated off your broking numbers, right?
Correct. So you basically enter into the award with your numbers. Yeah. It's verified by your aggregator, and then obviously the numbers are then published in
publicly.
Order. Yep.
Amazing.
And at the moment, I think it's backed by CBA, basically, who's the major sponsor for it. But
incredible.
It sort of tells you the volume that people do out there.
It's a third year broking and number 56 in the country.
Yep.
And how many brokers are there in Australia at the moment, roughly?
Probably close to 20,000 now, I think.
That's incredible.
Yep.
Well done.
Yep.
Very good.
Keep in mind, some don't publish, but the ones that publish, yeah.
Absolutely, but I mean, you've got to be in it to win it, and so well done for doing that. And we know the pool that you've gone up against too, so it's a massive achievement. You can float that radar, don't worry about that. Mate, thanks so much for joining us. So we've got a couple of topics today that we want to hit on. Obviously, the recent announcement of the rate drop, which is always the topic of the time as soon as it happens. For us, we know we like it because it puts sentiment into the market and it makes for competitive bidding inside areas that are potentially less affordable at the time to be stimulated to become more affordable as time goes on as those rates drop. But why don't you give us a bit of a lay of the land around sort of the ideas around the rates dropping and where we see that going into the future and how your dictation of that manages different loans and banks and structures and strategies and so on.
Well, I guess every lender looks at it slightly different, but at the moment, most of the major lenders are sort of predicting in the next 6 months they'll probably have 2 to 3 drops more.
Right.
So we're probably predicting...
To what values do you think?
Well, either 0.25 each, so probably other 0.75 in total.
Okay.
Now, it may not happen, keep in mind, July, everyone thought there was going to be a drop. That didn't happen.
Yeah.
August happened.
And once this does happen, the banks always have to react to the drop. It's not like the basis points drop and then automatically the banks adjust. They have to take their time. They have to do their little bits of homework, get everything in line to make things work. What's that? I guess which of the current lenders are sort of supporting that drop fastest at the moment?
Pretty much most of the major lenders do it straight away. Yep. If they don't do it, I guess it gets frowned upon.
Yeah.
They're willing to increase it when it happens, but if it drops, it doesn't. Pretty much all the major lenders have announced pretty much straight away, within a couple of hours.
Yeah.
When is it happening? So for most, it happens within 2 weeks, sometimes a bit longer. You will find some of maybe your second tier funders and your lower tier funders might take a bit longer to roll that through.
Yep.
There are some funders out there that are doing some extra things on top. So there's a lender at the moment that's giving you the 0.25 that got announced by the RBA, but then they're also offering an extra 0.25.
Right. So everyone's trying to get that competitive edge as well.
Yep.
Which lender is that?
Shouldn't be telling you about the lenders.
Oh, okay. Right. Well, that's fine. We'll keep your license safe.
Because it can essentially what it is, it's more if that lender suits that client. Not every client is for that lender. Okay, that's probably the best way to put it. I'd probably say...
This is why you're number 56, mate.
Probably easy 80-85%, I wouldn't put it to that lender.
Okay.
But there are people that we would take to that lender.
Sure.
So it's depending on the scenario.
I actually want to talk about that. So matching your criteria of a loan to your strategy, essentially. You just mentioned that it's not necessarily always working for that person who's just trying to get a loan. Why, give us an example of essentially why that would not potentially be the right decision for an applicant, essentially.
Yep. So I guess the more important thing is the goal. What are they trying to achieve? Rate's very important. Now, rate's not the most important thing. And the reason why I say that is we do get clients that come to us at the very beginning of their journey and go, Geoff, I want the best rate.
Yeah.
We do look at rate, but let's say, for instance, they could buy 2 or 3 properties. that's it at a certain rate. What happens if we were able to get you extra 1 or 2 properties, but the rate was 0.5% to 1% more? Does that make sense? At the beginning of the journey to them, probably no. And by all means, we obviously go to those cheaper rates to start with.
Yep.
When you start getting towards that end and you're getting tapped out, then you start going, hey, these properties have made really good growth, really good wealth over time. How do I buy more? How do I get into that next level?
Yeah.
Then their mindset changes and they start thinking outside the box.
Yeah, because you're getting into property because you want to capitalize on the value. If you're going to get stopped by doing that, by just the rate being a more attractive rate, then you are going to be held back. But that also goes to another argument, or question rather, where you could say, well, why can't I just refinance? There's obviously fixed terms and terms that aren't fixed. Are those the kind of areas where these rates are becoming more favorable at the moment? So, the announcement happens, the banks then adjust their rates, and then they provide the new products out there to the market. Where are these rate drops being contributed towards most? Is it fixed rates? Is it variables?
So the fixed rates, some lenders have actually dropped them prior to the rate announcement.
Okay.
Some lenders haven't dropped them since, but they will probably consider readjusting them. The variable rate is what moves. Now, you get all these headliners out there that talk about, it starts at this rate, and it happens all the time when we see it. Always get the message, hey, Geoff, I've seen this, but then that's not the product that person's on, or it's for a fixed product or a different LVR. I guess if you're at 80% rates and under, variable rate's pretty competitive at most places. When you start borrowing above 80%, and let's say you're doing LMI loan at 90%, your rates on variable are normally unattractive.
Yeah.
And a way around that is maybe considering a fixed rate. Yeah. And in some cases, fixed rates could be maybe 0.5% to 1% less.
Yes, that's... Yeah, and with this rate drop, I mean, are those fixed rates becoming more palatable to people?
Yep, they are.
But then you're fixed.
You are fixed, but there's a bit of a strategy around that. So you could take a fixed rate. So probably go back a step. What I'm going to say is not financial advice. It's literally just going to be off the topic. So let's say, for instance, you take a fixed rate on a mortgage insurance loan.
Sure.
Let's say it is a variable loan, and you'll probably be doing, let's say 6.4 maybe roughly at the moment.
Yep.
You could probably get a fixed rate for the same product, and we're talking investment variable, 1 year fix, or depending on what you do.
Fix,
short term, let's say 5.64, almost 1% less.
Nice.
Which might mean that it's worth fixing it, because it means it's going to take 2 to 3 drops before it gets to that same level.
Exactly. So take advantage of that. It's a fixed term. It's a lower rate. Get into it now.
Yep.
It means that in that time, you're going to benefit it.
There's also a bit of a loophole. I wouldn't say loophole. It's more of a strategy. So if the fixed rate drops, you would then probably call up the bank to find out how much it will cost to break.
In the future, or while they're releasing new products and you are fixed?
No, so let's say you took a 1 year fix today.
Yep.
And it's 5.64.
Yep.
Let's say, for instance, in 2 months they announced that 5.64 is now 5.49.
Yep.
You could probably consider breaking that fixed term.
Okay.
Now, what happens normally is if you break a fixed term, there's normally some admin fees. There's normally a cost to break. Usually, if the variable rate is higher, which it will be if you're using mortgage insurance, it might mean that fixed rate is still going to be lower. Yep. So that means the break fee is probably 0 or very little. So it might be worth breaking to refix again.
That.
Yeah.
How many people do you see doing that?
I've done that on quite a few recently. Okay. Actually, in the last week, I've done that more than a dozen clients.
And is that because of the climate of what's happening with the
Correct.
with the rates being reduced at the moment?
Yep.
Okay.
Yep.
I like that. That's a good strategy. I mean, there's all of these little pieces that you can put together to create new little scenarios and structure your purchasing plan.
Yeah,
I like that. So loan types, we've just gone into fixed and variable. The fixed terms at the moment, most attractive that you're seeing put through 1 to 2 years. Is that what it sounds like?
I would probably only fix it for 1 year.
Yeah.
Just because of the climate that we're going through.
Okay.
That's me personally if I was to fix. I personally wouldn't fix myself, but every scenario is different. If I was borrowing in mortgage insurance, then I would consider fixing it.
Yep. Yeah, that makes sense. And the reason for that is because there's a higher cost on that loan because of the mortgage insurance. Yep. Typically, it's not just the LMI, but it's also the fact that you've got a higher deposit or higher loan amount according to the value of the property. And so that is going to cost you every payment more. So it is better to just get that down to a lower value or a lower rate on the fixed version for that period of time.
It's quite a big chunk. It's almost 0.5% to 1% difference at the moment. in that scenario.
How does that differ to rates inside an SMSF or inside a trust structure?
Yep.
Are these options available for investors as well?
Yes. So inside SMSF is slightly different. There are fixed options there as well. Now, pretty much your major lenders won't lend in SMSF anymore. You have to go to obviously some smaller banks to get that. Your rates at the moment, probably as of today, probably 6.79, and that's before the 0.25 kicked in.
Yep.
So we're obviously still a little bit higher than your normal home loan rates, but it's a different avenue to lend.
A very different avenue.
Correct.
Yeah.
If you're buying inside a special purpose vehicle, so trust or company, in that scenario, you could take fixed rates as well.
Yep.
They are normally higher, but taking a fixed rate could normally, make it a bit lower for you as well.
Yeah.
Same strategy as before.
Let's touch into that a little bit about the sort of the SMSF structure or a different vehicle. Let's go particularly SMSF. If we were to buy an SMSF, how does that loan application get assessed for the SMSF trust structure?
Yep. So what they do is they will use your contributions from your employer, anything extra that you have been contributing on top, and then they'll use the rental income and then look at that in isolation. So if you're tapped out in your personal name, it could be an avenue to maybe buy other property. Now, you might need to contribute extra to make the deal work, depending on what your income levels are at. Now, if you are self-employed, a little bit different. So lenders look at it slightly different. Some will need 1 or 2 years proof before they can actually use that income.
Okay. And that extra contribution that gets put towards it, that's basically there. So that's the holding costs of the properties within the trust are secured, and the banks have got a little bit more security and palatable feelings around it.
The contributions and the rental yields
is
basically used for servicing to making sure that you can repay the loan. That's pretty much what it is.
Yeah.
You can leverage up to 90% in SMSF. Normally we don't recommend it. We would tend to do 80% or under.
And why is that?
Just because you want to start paying down that super fund lending. The end goal is you probably want that debt not to be there at the end of the retirement phase. You want to basically pay it down. Simple as that. Rates are higher, mortgage insurance, that sort of stuff. That's the reason why. But it's case by case.
Yeah. And interest only versus P&I on these options?
Yep. You can do interest only. I'd probably do P&I.
Yeah.
The reason why is we want to pay it down. Obviously, interest only works great in your personal name when you're not reducing the debt and you've got tax deductions and so forth.
Yep.
Chat to your accountant about the deductions.
Sure.
But other than that, I would probably consider P&I repayments inside super.
And that's obviously because you're putting those extra contributions in, that's what's going to be absorbing those extra contributions. So it really is a balancing game, but I believe your accountant is the one that's going to be able to help you with...
We can guide them through with the accountant's help as well.
That's right. In terms of like the different loans going into different parts of Australia at the moment, I mean, we saw a large amount of interest going into WA over quite a few years. Before that, it was the Queensland markets. What's happening at the moment where you're seeing the most amount of applications being processed for?
I would probably have to say the WA and the Queensland markets softened a little bit recently. We are now starting to see people buying in the Northern Territory and Victoria markets.
Yep.
Victoria probably the more prominent one out of the lot. It's probably one of the more hotter markets at the moment. I am seeing a few short valuations because of that, because obviously prices are moving and the valuation companies just haven't caught up yet with the data.
Yeah.
That's what I'm seeing.
It's such a difficult conversation to have with people when we know that the data is just lagged and there's a process of a property going through and we're doing the valuations so that we can get that formal approval across the line and it falls short. And you really just want to explain that a little bit further. But the reality of it is that the data that is captured from the valuation standpoint has to go through Valuer General in a lot of cases as well. And there's quite a bit of a lag in that process. However, valuations of recent sales also only get exposed within about a month after they actually happen. And when you're inside markets that are doing 1.5% to 2% a month when they are aggressively growing, the lag there of valuation doesn't stack up, and unfortunately, it just doesn't get accepted by the valuers. Even though they're on the ground in a lot of these places.
Yep. You want to know one of the reasons why?
Yeah.
So the reasons why is if a sale is done today, it doesn't settle today. So let's say it takes 6 weeks to settle, which is probably the average.
Yep.
It then basically means in 6 weeks when it settles, it's then the data that the valuers use to basically, do the estimate, because that deal could still fall through in their eyes.
Yep.
So it's not guaranteed.
It's not confirmed as a sale yet.
Yep. So it takes probably 2 to 3 months to catch up in the data. That's what we tend to find. Now, the solution around that is there's a couple of solutions. If you get a short val, is that's not the only bank, unless that is the only bank for that client.
Yep.
You would then shop that with other banks to see if there is a valuation that comes in at contract or closer to contract, and see if there is an option to bridge the gap.
Yeah,
that's it.
And I think really what's important here is to if somebody does come up against this and there is a bit of an uncomfortable feeling around the valuation feeling short, go and look at the transaction values. Obviously, you can't do it today because for exactly the reason that you just said there. But go historically and look what's happened over the last couple of months and have a look at the trend climb value for the same type of asset inside that market. And you will recognize that the market is moving. It just hasn't yet been recognized enough.
Yep.
Yeah.
See it all the time when it's a hot market. Victoria's unfortunately seeing that right now. All the other states haven't had that for a while. It's literally just Victoria.
And it's cyclical. It's something that, it happens throughout the whole country. Like you said, WA had it, Queensland had it. It's Victoria's time now because they've had relaxed, say relaxed growth, because it has been very relaxed over quite a few years, and in that time salaries go up and the ability to repurchase becomes more attractive as soon as other areas become less attractive, and so Victoria's having its go at the moment, really. What about the loans going into these areas? Are you seeing them more being, I know you guys are Sydney based, so you'd probably be supporting, and you guys do support a lot of investors anyway, but the data around home purchases versus investors inside, let's go with those two areas that you spoke about, Northern Territory versus Victoria. What does that data look like to you guys at the moment? What are you seeing more of and where?
Pretty much in those states there, mainly investors. Yeah. Mainly investors. I think probably first home buyers. I did have a few first home buyers in Victoria, but majority, the bulk of the clients, I would say for me on my clientele books, I would say at least 80 to 85% is definitely investors. Yeah.
Look, you guys obviously are also an investor-focused brokerage, right? So that is going to play a part of that, and you're Sydney-based, but so it makes sense for those to go through as investor loans. On the flip side of that, we have got our partners inside Victoria markets, and they are also buyers agents, which I think you know a couple that we work with. But their PPOR purchasing has gone up quite a lot, and those are the biddings that actually inflate the markets, because those are the emotional purchases, and these are the guys that are pushing up the values for the equity to obviously create the wealth that we're all looking for.
I think Victoria's a good market to buy in because it's affordable for most. That's probably the best way to put it. Yeah, right. Okay. Seeing less of that up in Northern Territory? More in Victoria.
More in Victoria. More affordable. Where do you reckon's next to hit?
I think that Victoria market.
Victoria markets, all the different suburbs around there, just opening up in more affordability. And as it does happen, it becomes more competitive and more difficult to buy in these areas, which is always a trouble that we come up against. So typical time frames in other markets, I guess let's talk about the strategies of buying inside different markets. So we touched on WA, we touched on Queensland, talking about Victoria at the moment. When it goes forward to putting a finance condition on a contract, how do you are there any tactics that we can use around aggressive markets that we can work within?
Yeah, for sure. So I guess that's where you would obviously the buyer's agent and the broker will come to play a bit more. We'll communicate in the back end. It's very common in WA and Queensland to have 14 days or 21 days finance clause. If you put that on the table on Victoria, you might find that your offer's not getting looked at. So what we need to do is we need to talk about, is that property good? Is it at a good price? Can we minimise that turnaround time?
Yes.
If you make an offer, are we able to do even an unconditional offer? Okay, case by case, depending on the client profile, and making just a more aggressive offer. Simple as that. No different to auction terms.
So how do you find comfort with going with an unconditional offer? Because it's such a huge value, being able to have that confidence that the offer will be accepted. What are the tricks that we do to get that in place?
To make an unconditional offer, I think you got to understand the property, what you're making as the offer, looking at the data, where it's going to be. Within range of probably what you see on RP data and so forth, you'll find that most banks will probably accept within a certain range level. Now, if that client has got a lot of cash backings or a lot of equity backings, then we have no risk. If we've got other properties that we can lean on to make up the gap, even if the valuation falls in $5,000, $10,000 short, there's no risk. We can make an unconditional offer. We can make that offer solid and wipe off everywhere else.
And so that's basically running our own due diligence around being comfortable with the finance in the area, being supported from the recent values of sale that we can assess and that we're on the ground knowing about.
I do that quite a lot with, I guess, owner-occupied purchases in New South Wales.
Right.
Constantly. Because if you don't do that, you're not in the market. Simple as that.
Yes.
We do that in some purchases interstate as well. But when there is a finance clause, we take it. If there's no, and if it's very aggressive, we talk case by case on each one.
Yeah.
Simple as that.
And New South Wales is a funny one because it's got a different purchasing structure towards the rest of most of Australia, really. Yep. And there's that due diligence period that comes up front with a New South Wales contract. So there's a lot of time to be able to do that. In the other markets, for example, like Victoria that we're talking about, you don't really have that luxury. You really got to be proactive in that approach. Yep. Yeah.
It's snapping up very quickly.
It is. So I guess at the moment we're seeing quite a lot of interest in this Victorian market. Historically, there wasn't so much with the whole stamp duty, being a thing for people to tackle with and for people to find comfort with buying a property which is going to immediately incur land tax.
Yep.
It hasn't really stopped anything, and we've just seen that, the investor market inside these areas is now blowing up, which is great. But it also is such a nominal amount in comparison to the rest of what the value of the property is projecting and creating. So do you see like this sort of a factor becoming something that impacts other property markets going forward, or should it be something that impacts other investors going into other markets because they are seeing affordability or if they're seeing the potential to buy in these areas when it's such a nominal amount? I mean, I know that South Australia, for example, has got higher stamp duties.
Yep.
So that kind of an argument, I mean, do we see that these are really the decisions that should be impacting a investor purchase process?
That comes down to your numbers.
Yeah.
So with any property purchase that you buy, you got to figure out your numbers. Does it make sense? The buy-in cost, the holding cost, and so forth. So I guess the Victoria market has seen people exit that market with obviously things like that happen, which is why it's plateaued, why it's gone backwards. Now people have come to the conclusion the numbers still make sense.
Yep.
Even if your yields are lower.
And it's comfort.
Correct.
It's just getting comfortable with what you're getting into.
Yep, correct.
It is also that other thing that there's, so it's not always greener on the other side, but in this case, it has been for so long. That's why I think Victoria had a little bit of a stigma against it for such a while. Yep. But in that term, it actually kind of worked in its favor because
it
relaxed so long.
Yeah.
There's other markets that are coming into Australian new cycles, or the new investor cycles and new growth cycles. And while we're saying markets, we're talking states and territories here, but there are a lot of markets inside Victoria that will continue to grow for a while. But I do feel that because of the cyclical nature that people get deterred of going into areas or are attracted to go into areas, that other markets or other areas rather become the next opportunities in the future. And I'm quite hopeful to see, hopefully, South Australia come on a bit of a rebound again. I know that it has had a good long run, but so has Brizzy, but for right reasons too, because of infrastructure projects and
I feel like it's
capital
like you said,
going into
it's all the pockets, all the individual pockets that you buy inside those states. Because it's not the whole state and as a whole, it's the pockets that you guys buy.
Absolutely, that's right. And we see that a lot when areas become too inflated in value and then they move on to the next suburb over because the amenity profile is very similar and it makes no sense to spend more money to get the same thing. And we see that as well going from a rental market into a buying market. When the rental prices become too expensive in an area, that rental market turns into a buyer's market inside that same area, and vice versa too when rates adjust and those holding costs become too expensive inside an area, and then rent becomes more attractive, and then people move into the rental market within a suburb. So we're almost talking about markets within markets within markets within states and territories, and I think that's the part that we really get excited about here.
That's what your data's all about.
That's it, mate. Absolutely, Geoff, mate. Thank you very much for your time today on the Lazy Equity Podcast. It's been a pleasure speaking with you again and hearing all your valuable insights. Join us again next week for another episode of the Lazy Equity Podcast when we tackle a new topic in the property investment landscape. Make sure to like and subscribe, and until then, keep well.